Hey, welcome back to Compounding Quietly. High yield doesn't mean high return. That sounds obvious, but JEPQ is where a lot of investors learn it for the first time. If you've been drawn to this ETF because of what shows up in the income column, that instinct makes complete sense. But the number you see on the yield line is not the whole story. Let's get into it. There is a specific kind of moment that brings most investors to JEPQ for the first time. The market has been moving sideways or pulling back, and the portfolio balance isn't going anywhere meaningful. You've been patient, you've been consistent, but the number on the screen just keeps drifting, and the strategy starts to feel abstract. And at some point, the question shifts from, how do I grow this, to, how do I make this start doing something? That's when high-yield ETFs appear on the radar, and JEPQ checks a lot of the boxes that come with that shift in mindset. Monthly income distributions, a yield figure that most equity ETFs can't come close to matching. Exposure to NASDAQ 100 names, the companies at the center of the global technology economy. It feels like a bridge between income investing and growth investing. That feeling is not entirely wrong, but it is incomplete, because the structure underneath JEPQ is doing something very specific, and that structure deserves your attention before you make any decision. JEPQ is not a growth ETF that also happens to pay income, and it is not a bond replacement that happens to hold technology stocks. It is a covered call strategy, built on one of the most volatile indexes in the world. That combination, high income, funded by high volatility, has a logic worth understanding clearly. It shapes everything about how this ETF behaves. Most investors who arrive at JEPQ are in a similar emotional place. They are not looking to speculate. They are not chasing complexity. They want the portfolio to produce something visible, something consistent, something that confirms the work they've been putting in is actually moving forward. That desire is completely real, and it is not a sign of impatience. It is a sign of wanting your strategy to feel tangible. But the question worth sitting with is not whether JEPQ pays income. It clearly does. The question is, what are you exchanging to receive it? Let's walk through how JEPQ actually works structurally, not just on the surface. JEPQ holds stocks from the NASDAQ 100. These are the largest non-financial companies trading on the NASDAQ. They are heavily concentrated in technology, semiconductors, software, and the platforms that define the modern global economy. But unlike a passive index fund, JEPQ doesn't simply hold those positions and allow the market to do its work. It simultaneously sells call options on the NASDAQ 100 index. Selling a call option means agreeing to deliver upside beyond a specific price level to the buyer of that option. In exchange for making that agreement, you receive a cash premium immediately at the moment the option is sold. JEPQ collects those premiums consistently and distributes them to shareholders as monthly income. That is the origin of the yield. Here is the clearest way to picture this structure in real-world terms. Imagine you own a beach house in a neighborhood that is slowly becoming very desirable. Instead of waiting for the full appreciation, you make an agreement each month with a buyer. They pay you a fixed fee, now reliable, monthly cash in hand. But if the house's value crosses a certain threshold, they have the right to purchase it at that pre-agreed price. You are being compensated for certainty, and in exchange, the open-ended upside belongs to someone else. That is the structural exchange at the center of a covered call strategy. You receive income now. In return, your participation in strong price appreciation is capped the moment the market moves sharply upward. Many investors hear this and think that's an acceptable trade-off. I just want the monthly cash flow. And for a certain kind of investor, in a certain phase of life, that reasoning is completely sound. But what tends to surprise people is the scale of upside that gets left behind in a strong bull market. When the NASDAQ 100 gains 25 or 30% in a single year, which it has done, JEPQ will not follow that move. The distribution arrives in your account each month, but the price appreciation you would have captured by simply holding a NASDAQ index fund is no longer part of the equation. That gap can be significant over time. This brings us back to the original question. Is JEPQ right for your portfolio? That is not a question about the ETF itself. It is a question about where you are in your investment journey. If you are in the accumulation phase, building wealth over a 15 or 20-year horizon, a covered call ETF may be working quietly against that goal. Every dollar of income you receive has, in part, been funded by upside you've already agreed to give away. Reinvesting those monthly distributions can soften this effect, but it does not fully replace what compounding, uninterrupted capital appreciation would have produced. Across the same timeline, the math works against you in ways that don't show up clearly on a monthly basis. If you are in or approaching a distribution phase where monthly cash flow matters more than maximizing long-term growth, JEPQ has a coherent and legitimate role. The income is real. The monthly cadence is reliable. The NASDAQ 100 exposure gives the underlying holdings a higher earnings quality than many traditional income-focused alternatives, and for investors who have already built the asset base and now need that base to produce, the structural trade-off can actually align with the objective. The distinction worth holding on to is this. JEPQ is not a growth vehicle that also happens to pay income. It is an income vehicle that uses growth assets to generate that income. Those two descriptions sound similar. They have very different implications for your portfolio over time. One more thing worth naming before moving on. JEPQ's income is not a fixed rate. The premiums collected from selling options are tied to implied volatility in the market. When volatility is low, when the market feels calm and predictable, option premiums are smaller, and distributions come in below historical averages. When volatility rises, premiums increase, but the stress on the underlying technology holdings tends to rise alongside them. The yield percentage you see on a comparison screen is a trailing average. It is not a forward guarantee. Building your income plan around a number that will fluctuate is a different exercise than building around a number that is contractually fixed. That distinction matters when you are deciding how much of your income strategy depends on JEPQ. So what does this mean for where you are right now? If JEPQ is already in your portfolio, or you are deciding whether to add it, the yield is not the right starting point. The right starting point is your timeline, whether you need income now or growth over the next decade. Whether the structural cost of that income capped upside, volatility-linked distributions, fits the phase of investing you are actually in. Some investors look at JEPQ and see exactly what they need. Others look at it and realize they were drawn in by the number, not by the structure. Both of those experiences are part of building a portfolio that actually reflects your situation. There is no correct answer for everyone. JEPQ is not a mistake. It is also not a shortcut to something simpler. It is a specific tool built for a specific purpose. And using any tool well starts with knowing what it was designed to do and whether that purpose matches what you are building. Investing is not about finding the highest number on a yield screen. It is about matching the structure of your portfolio to the structure of your life. I hope today's conversation helped make that match a little clearer. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.